Hi, is everyone hearing us okay? Uh, let, we're really excited to be part of this webinar. We're excited to um, give this information and help you to create value within your business. And we're valuation specialists. So that's what we do day in, day out. So we're really excited to go through this. And the reason why we wanted to do this type of series is that a lot of people come to us and they come for a valuation of a business and they say, I'm looking to sell my business or I'm looking to buy a business. I'm looking for how how do I know what the value is? So one of the things that the reason, and that's the reason why we wanted to have this webinar series to actually go through and develop. These are some of the concepts that will help business owners increase the value of your business. So, with that being said, like to just introduce myself and our team. We've got a great team here at Haynie and Company. Um, my name's Aaron Abendroth. I have been working with businesses for over 30 years, whether it be from building value to tax strategies and more than not, what we're trying to do is to bring the best value of your business so that you can have the dreams and be able to go through the process of having a really good life. So that's a little intro of myself. Worked with a lot of different businesses. I'd like to introduce Ashley Edwards.
Yeah, so my name's Ashley Edwards. I'm the valuation manager with Haynie and Company. And I'm a CVA, so a certified valuation analyst. And this is all that I do day in and day out is help value businesses and help owners get the most value for their business. So we're really excited to be hopefully giving you guys some really actionable strategies to take away today and things that you can implement easily in your businesses to be able to increase the value for whatever your goals are for long-term success.
And then we have Esley Tan here.
Yes, I'm Esley Tan. I am a valuation analyst here at Haynie and Company. I also have my CVA license. I'm have about 2 years of experience, but really excited to grow and learn in this profession.
Okay. And I got to tell you straight out, I am so happy to work with both Ashley and Esley. And please know that we've worked together as a team. And besides the three of us, we've got other people within the firm that do actually help in our business valuation. So, with that being said, we're going to get into the meat of it. And we're going to talk about on the agenda the EBITDA and cash flow. We're going to look at strategic working capital management. We're going to look at streamlining operations, strengthening the balance sheet. We're going to also talk about mitigating risk within your business. And then also the end part is about intangible assets. And that's really important as we go forward.
All right, so I'll kick it off with maximizing EBITDA and cash flow. So business owners, I'm sure that everybody has a pretty good grasp of what these figures are. We're going to go down to the basics of it, and then we'll get into more strategic impact of these cash flow, these figures and how they're going to impact financial health. So having a good grasp on these numbers is going to be crucial for you to be able to make not only informed decisions, but also positioning your business for long-term success. So let's talk about what each of these mean for your business, starting with EBITDA. It's going to be your earnings before interest, taxes, depreciation, and amortization. Most people are probably familiar with this figure and are trying to measure it for their business actively. But what this figure is really doing is it's measuring operational profitability of the business. So this is just really thinking about operations. It's not including the impact of your other financial decisions that you're making, things like taxes that you're paying and interest that you're doing. And what it really helps you do is assess how efficiently the company is generating earnings just from its core operations. The difference between EBITDA and cash flow is that your cash flow is actually going to represent the cash moving into and out of your business, which is going to give you a better representation of the liquidity of the business and how well you're able to meet your obligations. Now, cash flow is going to give you a little bit more insight into how much cash you have available for reinvestment and for growth of the business. So these two figures are really giving you different things, but understanding both of them and where they sit can really impact the value of your business in the long run. So let's talk about that relationship. So EBITDA is going to show the business generating earnings, but it's not accounting for that cash that's available after all of your other expenses, so debt and investments, whereas cash flow is doing that. You're also able to take into account your working capital and your capital expenditures, which really gives you a clearer picture for daily operations and then for growth as well. But a strong EBITDA does not guarantee a strong cash flow. So if you have high debt or if you have a lot of capital expenditures, your cash flow may not be where it needs to be for the business to have a significant amount of value. Because when we're valuing a business, what really matters is the amount of cash flow. That's what someone wants to purchase, or that's when someone wants to, an investor may want to buy in on, right? They're looking at the available cash flow to them at the end of the day. And then on the flip side of that, just because you have, if you have poor cash flow, you might struggle with liquidity. And even if you have a high EBITDA, you might not be able to grow and maintain stability, especially during economic downturns. So managing both is really key to be able to increase your value. Let's see, moving on to the next slide. Okay, so there's a few metrics that you can look at, and I'm not going to go into the details on the formulas for each of these, but we've got operating cash flow, free cash flow, and cash flow margin. These all are a little bit different metrics. So to explain what they are and the differences, and you can just go research these formulas after if you're not familiar with what they are, and you can easily apply them to your business. Operating cash flow is, again, going to be cash generated by your core business operations. It helps you understand how much cash you're generating from daily activities. Free cash flow is what's left after your capital expenditures. So it's what's left to reinvest into the business, to pay down debt, or to pay dividends. And then cash flow margin is going to be just a ratio that will allow you to compare your operating cash flow to your revenue, which helps you understand how effectively your business is converting sales into cash. And really that's giving you your operational efficiency, right? So those three metrics are something you can easily go do a little research and implement and get a better understanding of your actual cash flow in the business, depending on what it is that you're looking at and wanting to understand. Now, effective cash flow management. So coming back into being able to grow the business, being able to effectively manage your working capital is a really essential part of making sure that your business has enough liquidity to be able to meet operational needs. So I'm going to let Esley jump into that in the next section. He'll talk a lot more in depth about managing working capital. But the other big one for cash flow management is controlling your costs. So actively be monitoring and controlling those operating expenses so that you're avoiding higher outflows than inflows, right? Or just being able to decrease outflows where you can to result in a stronger bottom line. If you're able to optimize spending across all of your departments or the business overall, you're obviously going to improve cash availability at the end of the day. We have a specific business we wanted to talk about. It was an aerial firefighting company. And he had a little bit of a unique situation in that when he did evaluation with us, the business was worth about $9 million. And about a year later, he came back and did another evaluation after seeing some specific areas we talked about that we said, okay, these are some areas in terms of your costs that you're operating below average in the industry, and we think you're able to get lower costs. So go work on that, see what you can do, because he wasn't thrilled with the value he had, right? There wasn't enough cash flow available for him to get the sale price he was looking for. So he went away, he spent about a year working on this, and he increased the value of his business significantly. He had some other factors at play that helped with that. He was able to significantly land some new contracts, which landed him with a significant amount of revenue increase. But ultimately, he was able to really work on his cash flow and his costs. And when there's a lot more cash flow left over at the end of the day, he was able to increase the value of his business to about 12 million, which is a really big deal, especially in a year. And like I said, it wasn't all stemming just from the cost cutting, but it made a big impact at the end of the day. So going to work on cash flow is a really big piece of where you'll get more value for your business, whether you're looking to attract investors or sell, whatever it might be. How am I on time? Am I okay on time? Okay. So jumping into the next slide, cash flow management and how that drives business value. This is pretty straightforward, right? So being able to predict your cash flow is going to lend you a stronger business value. If you have healthy cash flow, it's consistent, that's going to be really highly attractive to buyers or investors. It's going to signal something for them that's going to be financially stable. And then companies with predictable cash flow are also going to be less risky. So again, more attractive to somebody looking to buy in or purchase the business. Cash flow forecasting, being able to provide accurate projections is another really important one. It allows you to, and for investors to understand, but also allows you to know what's going to happen for your future cash needs. And also, understand if you're seasonal, understand what those fluctuations might be, and understand what cash levels you need at different points in the year to be able to account for that. Again, it all comes down to these will help you mitigate risk. Operational flexibility and growth. So it's going to give you the flexibility to reinvest in the business, pursue those growth opportunities if you want them, and also manage the unexpected downturns, whether it's economic, industry related, whatever it might be. But if you have strong cash flow, you are better positioned to scale operations, get into new markets, whatever it might be that you're looking to do, you're in a better position to do it. And I've already talked about reducing risk. So overall, all these different tactics are going to reduce the risk of the business. And when we're valuing businesses, your individual business risk is a big part of the ultimate value of your company. It's a big factor to how we land at the value that we do, because we're looking into all the different things of your business. And again, that's a section Esley is going to talk about in a little bit, I think. So I'll let him cover that. And then the last piece of this is long-term sustainability. So if you're, I think I mentioned this already, but if you're able to have a strong cash flow, you're going to be able to weather any economic challenges that are coming your way. You're not going to have to compromise your operations and do things differently to be able to get by. And you'll have a stable cash position, hopefully would be the goal, so that you don't experience liquidity issues if and when you have downturn situations. So I think that's about it for things you can walk away with on EBITDA and cash flow.
So next we'll talk about strategic working capital management to improve your liquidity. And so working capital is just the difference between your company's current assets and current liabilities, and represents the short-term financial health of your business. And so to manage working capital effectively, you want to conduct a working capital assessment to evaluate your company's short-term assets and liabilities, and then set clear objectives for desired liquidity ratios and cash conversion cycles, which we'll talk about a little bit later. And so having efficient working capital management ensures cash availability for daily operations and strengthens your financial stability. And mismanagement can lead to liquidity issues or even insolvency. Right. So then proper working capital management allows businesses to seize growth opportunities and reduce reliance on external financing. And so there are three key components of working capital. You have accounts receivable, where the goal is to drive predictable cash inflows, as Ashley was talking about. Inventory management, where the goal is to optimize stock levels. And then accounts payable, where your goal is to improve your outflow strategies. And then we'll talk about these on the next slide here. So for different strategies for optimizing your inventory levels, you can adopt tools like just-in-time systems or AI-driven demand forecasting to minimize overstocking, and then performing periodic reviews to phase out obsolete inventory in your listings there. Excess inventory ties up your cash that could be used elsewhere, and shortages risk operational delays and lost revenue. And so you want to make sure you're optimizing your inventory levels so you can free up resources for other revenue generating activities. The next one is,
Can I just chime in on that? So
yes,
excess
go ahead.
inventory is something that we see all the time when we're valuing companies. So owners just aren't aware of, paying attention to, or being on top of what those inventory levels are. So that is a really big one that we see. So if you're a business that holds a lot of inventory, or you have inventory in general, just staying on top of that number can be really helpful.
One thing that can help you in that aspect is when you're looking at your accounting system and you're looking at your inventory aging. That's an important report when you're looking at inventory levels.
Thank you for that. And then the next one is speeding up collections. You can implement stricter credit policies, perform regular customer credit checks, and then you can utilize automation tools for invoicing and setting follow-up reminders for overdue payments as well. And receivables are a major source of your liquidity. And so getting timely collection ensures funds are available for reinvestment for other strategic initiatives as well. The next one is extending payment terms with suppliers. You can approach your suppliers and try and renegotiate payment timelines that better align with your cash inflows. This can help you avoid late payment penalties and maintain strong supplier relationships, and improve your short-term liquidity as well. And then you can strategically allocate cash resources towards other high priority areas such as marketing, R&D, and training. And then lastly, we have cash flow forecasting. You can develop rolling cash flow forecasts that update based on real-time data. This can help you predict your future liquidity needs and address potential shortfalls before they come up. And this will help prevent operational disruptions. And then next we have managing liquidity risk. We have liquidity ratios. There are two primary ones, the current ratio and the quick ratio. They're relatively simple formulas. The current ratio is current assets divided by current liabilities. It would be good to have a current ratio of 1, just because that means you can pay all of your short-term liabilities with your current assets already. But you also want to make sure you're in line with industry benchmarks, because by knowing where your competitors are within the industry, you can kind of align yourself towards that and make sure you're as liquid as other competitors in your industry. And next we have contingency planning. You can establish access to revolving credit lines and build a reserve cash fund that covers 3 to 6 months of your operational expenses. This can help you during downturns, market disruptions, or if other unexpected expenses come up. And then on the next slide, we have the role of technology. We've kind of sprinkled this in already, but you can always integrate enterprise resource planning systems to gain real-time financial insights, enabling better decisions on receivables and payables. And then you can automate repetitive tasks like invoicing or payment reminders using technology. And then, like I said earlier, in the inventory management, you can use AI to align your stock levels with real-time demand. And so technology is very useful, enhances decision-making, reduces errors, and can help you improve your liquidity overall. And so in conclusion, for this portion, developing a comprehensive working capital strategy is very helpful in improving your liquidity. And by doing so, you can increase your business's value by using that liquidity towards other things or reducing costs as well.
Ashley, just a question for you. When, let's say I want to start doing this, what would be some of the things that I would want to do? Creating this type of plan.
I would start with your accounts receivables, making sure you have good collection policies and that you're not waiting too long on collecting those. By getting those earlier, you can invest into other opportunities and all of that. I think that's where I would start, at least.
Okay.
And then from there, if you have inventory, I'd work on your inventory, as you guys were stating earlier.
Yeah, I think you said earlier too, but also looking for early payment discounts for any accounts payable is another really good one. Just an easy place to start, right?
Yeah. Good. Thank you. Okay, on to the next slide. Okay, one of the things, just like any business owner, as you have to deal with streamlining operations. Okay, we've got to reduce inefficiencies and improve workflow. Now, that's great, right? But the question is, how? How do I go and do this? Well, one of the things is a workflow analysis. And a workflow analysis, you can identify the bottlenecks and the inefficiencies within key processes. Okay, using tools like process mapping or conducting regular process audits can really highlight areas where improvements can be made. Let me give you, for example, you have inventory and you have a warehouse. One of the things that you can even go through the process is to say, okay, where am I? Where are my biggest movers of inventory? Where am I storing those? How am I staging my actual installations? For example, a fireplace installer, they will want to stage for the next day. And if they're able to use a staging area, that will help to actually improve that when the installers get in the morning, they can easily get the information, get the inventory that's on the fireplace, and they can put that into the truck and get it out, and you don't have as much time wasted by, okay, I need to send my installers, they got to go find this product X, and then they come back to the truck and then they go back and get another part. So there's different ways when you start to look at your workflow analysis, you're going to want to very easily try to document every step that you're doing. Okay. And then look for the duplication. Okay. There are redundant tasks that sometimes occur. And that's where the time and cost savings really are generated because we're able in the workflow analysis to say, okay, we've got this area that's taking too long. It's a redundant over process here. How can I improve? I'll even give you an example for like a restaurant. A restaurant that you know that they have an ordering. It's a cafe where they order the particular product and it goes to the kitchen. And instead of having, okay, the ticket is out, there's got to be communication back into the kitchen so that it can easily get the food out and it's a faster process than a person coming up and saying, "What was the order?" And so you have to eliminate all of these redundancies and these bottlenecks that can really impact your whole process. And if you're looking at it from that perspective, you're actually getting more revenue because you can work faster, you can provide more uh, services and product to your customers. On the next slide, we talk about employee involvement. Employee involvement is absolutely critical. I can tell you straight out that your employees, they really know where the inefficiencies are. They'll look at and yes, it's sometimes frustrating as a business owner. Hey, my employees, they're frustrated with this. I'm doing the best that I can. But if you're encouraging hey, help us to create this process. Let's make your life easier along with my life easier and use it as an opportunity to get everyone to buy into the most efficient process. Then, guess what happens? You get people that are bought in, you get better revenue, you get better customer service, and in effect, you create more value of your business. So let's give you an example of financial advisory firm that we did evaluation with. We were talking to them and we were asking, well, why are you getting this valuation? And he essentially said, look, I want my team members, and that's how he referred to them. I want my team members to be involved within the business. So I'm doing evaluations so I can actually offer them some ownership that they're involved in it. And as a result, at the end of the day, he felt like he was going to be able to provide more value to his customers, and eventually the value of the business will actually increase. And it did. And since that time frame, I do know that they have been growing, and it's been a good thing for the advisory firm. In the next slide, we'll be talking about we've referred to this before. Esley and both Ashley have talked about automation and emerging technologies, AI and machine learning. I can remember, this ages me, but 1994, it was my first tax year. And I'm going, okay, all paper. It was all paper. I got so sick of paper being in my office. I just, I, but now today, what's happening? Paper is becoming less. AI, machine learning, they're leveraging that help because as we all experience life, um, if we can make our lives easier, let's do it. So one of the things to do is to embrace AI and machine learning. Okay, that's AI can assist you in inventory management, demand forecasting, customer service. There's a lot of different ways. So please embrace this because that is also going to make your life easier. It's also going to show when we're valuing your business that you're focusing on improvement. That's an important task. One of the things, the advanced tools that you can use for automating processes, order processing, invoicing, a lot of that depends upon the type of accounting system that you have. But if you're able to start to use this automation, one of the things that you can significantly reduce are the errors. It saves time. It also allows your employees to concentrate on doing higher value tasks. What would those tasks be? Well, it would be talking with the customer, making sure the experience with the customer is better. And as a result, you're going to have more repeat. It's going to increase the overall value of your business. So as we move on to the next part, we also talk about scalability and efficiency. Um, you know, there's a great book out there. It's a little older, but it's important. It's called The E-Myth Revisited. And the E-Myth talks about a lot of times a person who starts out in business, they're a great technician, meaning they know what they're doing. For example, HVA installer. Hey, this HVA installer is really good at what they do, and they're great technician. Well, some down the line, there's, hey, I want to become a manager. Well, the skill sets for a technician are very different than a manager. Okay. And then the manager learns these skill sets and then becomes an entrepreneur. They say, I'm going to be the boss. I'm sick of working with with my boss. So I want to create my own business. Well, the skill set for an entrepreneur is very different. So as as a business that starts out with a single sole proprietor begins to have more and more employees, you have to also scale your processes and encourage the technologies so that people are using it and that we're concentrating on really what comes down to is the experience that the customer has, that it can be repeat business. And as a result, it creates more value within your business. So the next slide, as we talk about, we're going to talk about the balance sheet.
All right, so we'll jump into the balance sheet. We've got, in the people that we work with a lot of different types of business owners. And some business owners are really, really engaged in the financials of their business, and other business owners are really just engaged in the operations. And both are fine. But being able to have a really good understanding of the balance sheet and how it will impact your business overall is a pretty big deal. And it's worth taking the time to stop and learn what that means, or get some consulting on it and help make sure that your balance sheet is in a really strong position if you're ever looking to make a change or grow, those kinds of things. So to start off, we'll talk about debt reduction. So if you have excessive debt, this is really important, because if you have high interest loans, it's going to really limit, back to financial flexibility, it's going to really limit what you can do flexibility wise, and it's also going to increase your risk for your business overall if you've got that high debt, especially if you hit an economic downturn. So some key things you can do here: paying down high interest debt first. So if you focus on going in and eliminating the loans with the higher interest rates, it's going to reduce your cash flow strain, and it's going to free up your resources for reinvestment. Leveraging your equity. If you reduce your reliance on your debt by refinancing your profits, or even by raising your equity, it'll help you just create a more financially stable structure. And then the third, creating financial flexibility. That's basically what this is doing, right? So lowering that debt gives you more room to navigate challenges, and it's also going to let you seize expansion opportunities. So that's a big one, debt reduction. And debt can look different for every industry too. So let me be clear in that. There are some industries where more debt on the books is going to be very, very normal. And there are other industries where it's not more normal to have a ton of debt on the book. So that can really depend on the industry that you're in. It can be helpful to look up industry information and kind of get a gauge for where you maybe should be sitting with the amount of debt for the size of your business. So anyways, the strategic impact of that is really that your debt load is going to, if you lower it, it's going to reduce your risk of the business, increase your financial flexibility, and allow you to better respond to market changes. Then we've got liquidity. So ensuring cash flow readiness. Why that's important is because your liquidity is going to ensure that you can meet your short-term obligations. And it's also going to ensure that you can act quickly if you have growth opportunities. If you're not liquid enough, you're not going to be able to do those things. So some key things you can do here: build your cash reserves. You don't want to have so much cash on your books that it's just in excess, right? There's better things that you can be doing with that money, but it's good to have a buffer of cash and easily convertible assets so that you can weather downturns when they come, and you can also cover any operational needs during those downturns. Getting quick access to funds. So this helps you make sure that your business can make swift and strategic decisions without having to wait to have ability to access the money. That's a big one. Let's see. And then optimizing cash flow cycles is the third here. So actively managing those receivables, payables, and the inventory, the things Ashley touched on earlier, will help you maintain that healthy cash flow and liquidity. The impact of all of that is it's going to minimize the need for external financing because you've got some funds available, and it's also going to help your business act really quickly on those opportunities. So that is this slide. On to the next. Okay, so we've got financial stability. This isn't really just for enhancing investor confidence, but it is a piece of it. So if you do have that solid balance sheet, it's going to signal stability to investors, but also lenders, potential buyers, whoever the person might be. It's going to help with that. So when it comes to attracting investors, if you can show that you have manageable debt and ample liquidity and a good amount of assets, or maybe not, again, depending on the business, it's all going to be business and industry specific. So you'll have to think about how it applies to you. But assuming that it makes sense to have, solid assets, you're going to reduce your perceived risk for the business as a whole. So again, lowering financial risk, demonstrating that balance sheet is going to show that you're well managing it and that you're able to handle those unexpected challenges. And then long-term growth is the third. So if you have financial strength to thrive over the long term, you're going to be more appealing to investors because they're going to get more sustained returns on their investment. So overall, it's going to help in a few different ways. And then the last section on this is going to be reserves for growth and being able to fuel future opportunities, which I've already touched on a little bit. But if you're able to build reserves, it's going to provide you that foundation to be able to grow the business in the long term. It's going to allow you to do that without the external financing, which can be a really big deal when there's high interest rates. So let's see, what else do I want to touch on here? Seizing market opportunities and staying resilient in tough times. I touched on both of these a little bit, but if you're able to act quickly on strategic investments for your business, that's going to have a really big impact. You're going to be able to launch things quicker. You're going to be able to act on things like what Aaron was talking about with AI, right? It's big, it's scary, people are nervous about it, but if you have a little cash available and you're able to go and invest in that, you can really make some big strides early on in the process. And the companies that we're seeing do those types of AI and automation activities, they're really able to lower their cost and make things more efficient overall. It's making a very big difference in the value of their business, in their processes, their procedures. So, it just allows you, if you have the cash available, if you have the ability, it allows you to go take on those new opportunities, right? Because you've got the money to do so. And then staying resilient in tough times, right? That is so important. We all know after experiencing COVID, being able to float for a little while is a big deal, and having access to funds to be able to do so is a really big deal without having to impact your business's operations. So it's more about just managing your debt on a balance sheet. It's really about creating a foundation to be able to sustainably grow no matter what's going to happen. So that's all I have for the balance sheet.
Yep. So next we'll talk about safeguarding your business and positioning for future growth by mitigating risk. And so the first thing you can do is have a strong management team, and you can evaluate your current leadership, ensure there's a balance of skills across operations, finance, strategy, and then fill any identifiable gaps with new hires or targeted training programs for your current team. You can also create a formal succession plan for key leadership roles to ensure seamless transitions for any departures in that category there. And then you can also introduce leadership development programs to train promising internal candidates for future roles. And so having a capable and cohesive leadership team ensures stability and the ability to adapt to challenges that will come up eventually, right? And so for a case study here, we valued a metal folding company last year where the owners were planning to sell to two of their experienced managers who've been there for several years. So they know the company's process, the industry, and have built relationships with key clients and new clients as well. And so although the clients will most likely miss the original owners and the relationships they built there, they at least have a foundational trust with the new owners going forward. And so by doing that, the owners reduced the risk of losing those key clients to other competitors. And by doing that, they have maintained or even increased their business value there. The next is competitive differentiation. You want to identify your unique selling proposition and make sure you are marketing that to clients and potential clients as well. You can conduct regular competitor analysis and market research to stay ahead of emerging trends and adjust your positioning as needed. And then you can develop loyalty programs and personalized customer experiences to foster brand loyalty and maintain a competitive edge. Differentiation prevents your business from being overshadowed by competitors and ensures customer retention, and also solidifies your business's reputation within the industry to mitigate that risk and maintain your business's value. Next is customer and vendor concentration risk. You don't want to have too much reliance on a single customer or a single supplier, because if anything happens to either of them, you are in trouble and it'll significantly impact your daily operations, right? So you want to proactively find new market opportunities to find new clients if needed, or building redundancy in your supply chain by securing multiple vendors for your critical supplies. You can also formalize vendor agreements to ensure clear expectations, reliability, and predictable supply terms. And by doing all these, you can reduce the risk, the dependency risk in any of these, and then stabilize cash flow and make sure your company is adaptable to unforeseen events. And then you can also diversify your revenue streams, having multiple income sources from new product lines, services, or geographic markets reduces the risk of losing revenue in one of those. This is a little outside of the scope of this webinar, but you could also think about acquiring a business to expand your market, or being acquired by a business to also expand in that same aspect there. You can use market data to evaluate profitability and feasibility, and a diversified portfolio can protect against fluctuations in demands and changes in customer preferences. Again, for mitigating market fluctuations, you don't want to be reliant on one industry or one type of client. You can diversify into other industries and other client bases, and work in cross-selling and upselling. So finding complementary complementary products to sell to other industries or to other clients there. And so a diversified revenue portfolio shields your business from market volatility and creates multiple growth opportunities to enhance your stability overall.
Esley, just a question on that. If you do this and you have your customer and vendor concentration risk, you reduce that down, what does it do to your company-specific risk when you're valuing a business?
Yes, so the company-specific risk is the risk that's that's for your specific company. And so if you have a significant risk of vendor concentration or customer concentration, that really increases the discount rate that we use and the company-specific risk, right? And that ends up decreasing your company's value. And depending on how much risk we determine, it can significantly impact it.
That's why I was going to chime in on that. Company-specific risk and our overall discount rate is part of the valuation process, which maybe some people will do a valuation on their business when they're getting ready to do this next step, and maybe some won't, especially if they're working with maybe private equity or, you know, an experienced investor. They may not go do a full valuation, but either way, what is really important and what these companies, investors will be looking at is going to be the risk of your business. So it's not all numbers, it's not all financials. These things that you do to be as stable as possible across every facet of your company and how it operates will really make a difference in the overall value of the business. Whether you're getting a valuation or not, it'll make a difference in the amount of money that you get for the business if you sell or if you have an investor, whatever that might look like. These things make a big difference. And while not everything might apply to each business, overall, the concept of mitigating your risk and reducing risk as much as you can, it just makes a really big impact. So.
And then on the next slide, our franchise agreements, you just want to make sure to have clear territorial boundaries, make sure that avoiding conflicts between your franchises, establishing clear guidelines on service areas and operational standards to ensure consistency and quality, and then maintaining clear and enforceable agreements to ensure franchisees comply with operational standards and legal regulations. And so by doing all this, you can maintain control of your franchise operations and protect your business's reputation going forward. And lastly, we have the talent development and leadership. It's great to develop a talent pipeline by identifying high potential employees, creating tailored development plans for their growth, conducting employee engagement surveys to foster a positive and collaborative company culture, and offer regular training programs to upskill your workforce and keep them competitive in the market. And so a lack of talent development can lead to high turnover rates, skill gaps, and leadership vacuum during critical moments. And so we recommend investing in employees to boost their morale, loyalty, and productivity to ensure that your organization has the talent needed to achieve its long-term goals and withstand any disruptions there. And so in conclusion, by developing all these different strategies, you can significantly mitigate the risk within your company and increase your business's value in the long run.
You know, one of the things that a lot of people don't take into account, you know, a lot of times you have intangible assets. It's an asset that you can't actually touch, okay? An intangible asset sometimes allows the 1 + 1 = 5. Okay, and it's the crazy math. And you hear about some business that, oh, they got so many million for that business. Why? Well, sometimes it has to do with intangibles. And we'll talk about different types of intangibles here: patents, client lists, trademarks, And then more importantly, I think R&D at the very end. So let's go on to the next slide. Patents. We're talking about exclusive rights, patents that are uh, registered with the patent office that allows you to sell and to create uh, a particular product or process that actually creates a competitive advantage for you. Now, there's revenue generation by patents too, because you can actually resell or allow people to use your patent. So you can do product development with the patent, but you can also have people use your patent and receive money uh, to by other companies that could use your patent. You know, and a good case study for us is with a company that's a blockchain technology company, actually throughout the world. We did evaluation to uh, and looking at the number one question was, how much are my patents worth? Oh, well, let's take a look. And there were certain things that did qualify as a patent and other things don't. So it's important when you're creating a patent that you go about it doing the right way. With that being said, a lot of attorneys would love to, patent attorneys would love to help you in regards to that. So please be aware of that. The next is the client list. This is really key. Repeat business. A client list creates and demonstrates the ability to maintain relationships and generate repeat business. That it's an intangible that a lot of people do not take into account. You know, a lot of times you can have contracts related to the client list. Long-term contracts are key. Why? Because if you have long-term contracts, you can increase the value of the business because they have contract recurring money that is expected by the contract. Moving on to the next one, we talk about the next slide. We talk about trademarks. Do you have brand recognition? Have you gone through the process of creating a trademark? Okay, those type of intangibles like a client list, a trademark, patent, that it's all about putting your stamp that they know, hey, that is XYZ company. And if you think about the companies out there that you know by their logo, hey, that's that company that's creating value. Okay. Creating value then creates more for the value that you receive for your business. Okay. You create trust and loyalty through trademarks. And that's important to remember because these trademarks thus uh, increase the value of your business. Moving on to the next one, R&D. And I'm going to take probably the most time to just talk about this because R&D, it's an essential driver that you're going and you're growing with the business. You're creating innovation. You're creating progress. R&D can, and we are not talking about, okay, this needs to be R&D for just these biochemical companies. We are looking at this and we're saying, hey, R&D, when we're an excavator, what things can we develop that can make our processes better? That's what we're talking about, R&D. We're creating an ability for people to get better. As we look at all of the companies out there, R&D will also, it tells any type of evaluator that they are looking to increase the value of your business. Okay. And that's important when it you will have investors or potential buyers of the business saying, "Oh, what do you have coming down the pipe?" You can say, "Well, our R&D is in this area." And that will help to increase your value. And then just so you're aware, there are R&D tax credits that also can be used on something like this. With that being said, we're just right at the end of our webinar. If you'll go to the next slide. One of the things we want to recommend for everyone, there's a great book out there. It's called Good to Great by Jim Collins. It talks about the differences of uh, things that have made a business more valuable. Okay, and it gives some comparisons of companies that were better and were able to actually create more value. And so please read that. Another one that I truly do recommend is the E-Myth Revisited by Michael Gerber. There are a lot of different things that, at the end of the day, when you're trying to create the value of your business, it's got to be intentional. It's got to be also, it's going to take some time, it's going to take some effort, and you can't do it all by yourself, too. So, as a result, we and when we're valuing businesses, we're looking at these particular characteristics that Ashley has talked about with EBITDA. We've also talked about a strong balance sheet. We've talked about R&D. We've talked about process improvements. All of those different things uh, need to be looked at. But we wanted to kind of open up to questions right now if you have an opportunity. Okay. You can put your question, and I'm getting this uh, uh, notification from our host that you need to put any of the questions in the chat. I believe. I thought that you could actually open up the that you could actually speak. Okay.
We got a thank you, and then it was informative, so that's good.
Yeah. Okay. Um, Esley and Ashley, what things do you look at when you're looking at a company that's very valuable? What are some of the characteristics?
So one thing that stands out to me in a company that can have a lot of value is having a really strong key management team and low turnover in that team, to where that if there is an owner or maybe two owners, if something happened to them or they decided to go on vacation tomorrow for the next 6 months, what would happen to the company? That can make such a big difference in what someone's willing to pay for a business or the value of the business overall. So that's one thing.
Looking at just having strong cash flows, and having a strong net income, strong revenue streams, different ones, making sure there's not a significant reliance on just one customer or one revenue stream is also good to see.
Yeah, customer concentration is huge. We have a lot of companies we've worked with who have like one major contract with the government. And if they lose that contract, right, maybe they've had it for 6 or 7 years, but they're going, well, we don't know if we're going to have it next year. And then we don't have anything coming in. That is so impactful.
Okay. Any questions from the attendees?
I don't think we have any more. But thank you everyone for attending. We hope that this is helpful and hopefully it gives you some actionable insights. If you have questions, feel free to contact us. I think you'll get a follow-up email with our contact information. And so if you have any questions, we're happy to help. All right.
Have a great day, guys.
Thanks.
Thank you.
Bye.